David Moore, Equity Advantage, and I'd just like to thank everyone for joining us this morning. Today's title is Advanced Strategies for the 1031 Exchange. If you have not done one of our basic classes, you may be in for a ride. We're going to have some fun, talk about some transactions that have fixed problems recently, best practices, and a couple things you may or may not know are even possible. So I guess I'd like to say thank you again for joining us. And this is David Moore, Equity Advantage. And my brother and I started Equity Advantage in 1991 to handle tax-deferred exchanges. And we look at the process a little bit differently. We don't want to just hold your money. We want to know where you are and where you want to be in 2, 5, or 10 years. And we're going to work with you to get you where you want to be. And it's our experience through the years that a lot of times people just really don't know what they don't know. And there's lots of opportunities out there that you may have been told you could not do, and hopefully we'll sort of clarify some opportunities that might help you out going forward, whether you're an investor or a real estate broker, tax and legal professional. One other thing I would like to mention is that we have a sister company, IRA Advantage, that handles self-directed retirement accounts. And so that business was actually a result of our 1031 clients wanting to use more money to go out and buy more real estate. So a truly self-directed IRA or 401k plan is going to empower you with the ability to literally buy anything the law allows, which with an IRA, that's anything other than collectibles, life insurance contracts, or stock and sub S corp. 401k plans can buy anything other than collectibles. The rules have not changed. It's been that way since the mid-70s, since these accounts were put together. And it's actually, believe it or not, possible to combine personal money along with plan money into a common investment. If we're going to be using a 1031 to buy something that you'd like to co-own along with your IRA 401k, it's going to require tenancy in common structure because 1031 prohibits the exchange of partnership interests. If we're looking at just pulling money out of our pocket to go buy something, then you could own a property either via tenancy in common or as common members of a limited liability company. And that's obviously a topic for another day. So we are going to get started. We've got a full hour, and I probably am not going to be addressing any questions during this. The slide deck will be available for you in the future. The presentation will also be up on our YouTube channel. If you just type in Equity Advantage 1031 on YouTube, you're going to find out that site actually is full of information, whether or not you're looking for 1031s, cost segregation, anything on DSTs, seller finance, even QOZs are up there. So there's a whole bunch of things up on that site. They're aimed at, some of them are 1031 related, some are not. And it's really just information we try to get out to our investment community that we find may be helpful to them. And away we go. So as I said, we've got this sister business here, whether investing in tax world and considering a 1031 exchange deferred gains on a property, or this, using IRA 401k plans to go out and buy things off Wall Street, we can help you out. And we do not sell investments nor give investment advice. We merely provide the investment vehicle necessary. And I always like to say the only dumb question is the one that you don't ask. So don't hesitate to reach out if you got questions and concerns. Even if you're working with somebody else, we're happy to help you out. And we would hope that you would think of us next time. Why do we look at a tax deferred exchange? And we're usually, if we're talking about a basic class or a longer class, I'd go into this stuff more in depth. But really the only reason to look at an exchange is to defer taxes on something. And I want to mention it's not always 1031. I mean, if you've got a situation where you're selling a primary residence, we've got 121, the universal exclusion on a home sale, which today gives you 250 personally or a $500,000 exclusion for a married couple. To qualify for that 121, those exemption numbers, you have to have occupied the property for 2 out of the preceding 5 years. It's not what the property is at time of disposition. It's just whether you fit the 2 out of 5. So you could literally move out of a home. You'd have up to 3 years to still take advantage of 121. Now, I want to mention something that I've been complaining, whining. I don't want to say whining about this, but I hadn't heard anything about any changes in 121. Keep in mind that was put in place in 1997. Those numbers, I would say, probably need to be in the millions these days, not the 250 or 500. And it's really sort of interesting because just in the last few weeks, President Trump is looking at, he's actually got people, they're trying to eliminate any tax on the disposition of primary residence. So you can imagine they would have to really delineate what is going to qualify or not qualify, but imagine how many properties may become available on the market if those tax consequences were removed on the sale of a primary residence. So we're obviously going to, keep our ear to the ground, and we'll get information out on that as long as we see things progress through. But if we look at just basis and gain, your basis in a property is what you paid for it plus the capital improvements minus the depreciation. Your gain is the difference between that adjusted sales price and that basis. Now, keep in mind, even in a situation where you've got a short sale or a foreclosure, there are situations where you may have tax exposure. It's something called phantom gain. So on the disposition of a primary residence, you may have some tax relief in that situation. But on an investment property, unfortunately, we've had many transactions through the years where we're bailing out somebody that has even lost a property foreclosure, and they're looking at a very serious tax consequence. And it may be normal income tax rates, or it could be long-term capital gains tax rates. But if the debt on a property is in excess of the basis and a foreclosure occurs, that delta, that difference between those two numbers is taxable. And really, it's a very rude situation for people to wake up to if they're in that predicament where the property going away and they don't even understand, hey, I could be paying up to 40% in tax between a combination of state and federal tax. Or what we end up doing is, if we have the opportunity to get involved before the foreclosure, we'll actually structure an exchange in that situation. It's sort of strange because we don't even get any money from the sale, obviously. And the taxpayer, if they were made aware of it by their tax or legal people, then we can help them out in that situation. And it's really a pretty easy question to answer. You could lose it all, lose up to 40% in tax on that gain, or come out of pocket 20% for something called a zero coupon DST, Delaware Statutory Trust offering. So we did a lot of that in the last recession. We've got a few transactions as this time money. Obviously, if you got 4 units or less, we've got loans out there that are 10, 20, 30, 40 years. If we've got larger investment properties, we might have 5, 7, 10-year money. For the people that are looking at a situation where they've got a refi that's having to come up, their numbers might be substantially different than they were a few years ago, especially with the interest rates. And you might even have a capital call situation. Just be aware that you've got these things to look at. If you'd like more information on this topic, please don't hesitate to reach out. We can actually go through the details on how to structure an exchange in a foreclosure or short sale. But it's just one of those things. Keep in mind, gain has nothing to do with profit. Gain's simply a tax calculation. The gain could be attributable to depreciation recapture. It doesn't have to be attributable to appreciation. And keep in mind also that 1031's tax deferred gain. It's not tax elimination. So it's possible that you might have been exchanging over the last 10, 20, 30 years. You've got a very low basis on what was relinquished, and that's where those issues come up. So once in a while people say, well, hey, I'm going to have to pay tax at some point anyway. Why not pay it today? And I typically will ask them, well, do you have an IRA or 401k? Oh yeah, I've got one or both of those things. Well, why would you have them? Because you're going to have to pay the tax at some point. And think about the money, the tax consequence with IRAs and 401k plans. You're paying tax on any distribution at normal income tax rates. So the tax consequences, what's in your retirement, is typically going to be well in excess of what you're looking at with money out of your pocket on, let's say, a piece of property where you're 1031ing through life. And then ultimately, when you pass away, you get a stepped up basis current market value. So that whole, well, I'm going to have to pay the tax at some point anyway, really doesn't apply if you look at money out of your pocket. And it's really a question of, hey, I've got this situation. First thing I want people to do when they go to sell the property is understand what the tax obligation is going to be, because 1031, there is an opportunity cost. Anybody that's been in an exchange knows the biggest problem with 1031 is the timelines. You've only got that 45 days from settlement to ID what you'd like to acquire, 180 days to get it done. Well, maybe that works for you, maybe it doesn't. But two comments, I guess. One, just buying something to hide from a tax probably isn't the best idea. Two, buying something for more than you need to because you're in this 1031 is probably not the best situation either. So just before the seminar kicked off this morning, I took a real quick call for somebody looking at combining two properties into one replacement. And in that situation, the question came down to, hey, can I combine the two? And the answer obviously is yes. We can combine any number of properties into one replacement, or we can have any number of replacement properties or relinquished properties in a common exchange. The ID rules seem to imply that you might be locked in a three. But if you look at the ID rules, there's three different rules, each work independently of the other. And you've got a 3 property rule, 200% rule, and 95% rule. 3 property rule is pretty clear. You can ID up to 3 properties of any value. 200% rule says you can ID more than 3 properties, total value of which can't exceed 200% of the relinquished property's value. Third is you can ID more than 3, you can exceed 200%. You got to close 95% of the aggregate value of all properties identified. So as we increase numbers, it gets more and more probably critical in that timing and how you're IDing these things. And when you're in that transaction, I told the gentleman this morning, I said, look, if you've got one that's a sale pending right now, ask for whatever period of time you can to get the second property sold. Ideally, you'd want to have the second property selling inside the 45s, so you know how much property you're going to have to buy to satisfy the exchange. And he asked, well, gee, how much time do I have totally? I said, well, you've got 180 days from the first relinquished property's closing, but we can do something. We're going to talk a little bit more about this during the class. We can do something called a blended transaction, and you could take up to a year to get the deal done, because really what's happening is you've got a situation from the first relinquish, you've got 180 to get the replacement, and from the date of acquisition, you've got 180 from that date to sell the residual properties via reverse. So we can combine that delayed and reverse into one transaction. And again, we call that a blended deal. So I always laugh because this is probably going back 25 years ago plus. And Carlin, if you're on this call, you'll recognize the story. She came in and jumped in out of the banking world into commercial real estate, and she had 2 brothers she was working with. Her first transaction was taking 8 relinquished properties and putting them into a single replacement, and we used this blended structure to get that deal done at that point in time. So that was sort of a baptism under fire in the 1031 world for her to come in and successfully negotiate through that 8-into-1 transaction, make it all work. So that was definitely a success story and exhibits what is possible. And the other thing I want to say is 1031 is not all or nothing. Every dollar you spend over your basis on the replacement property represents tax deferred gain. So just don't buy more than you want just because you don't want to pay the tax. Understand also that what good is the exchange? What good is tax deferral if what you buy goes away? So really, this is an investment decision. It's not a tax or legal decision. One, you need to know what your tax consequence is going to be on disposition. Then you can plan accordingly going forward, and you'll know what makes sense. A situation where an exchange does not make sense. I had a client the other day. We were looking at doing a reverse exchange into a property that has yet to close, and that's a more expensive, complicated transaction to do. And you've got to sort of weigh all the costs of a transaction. So in this situation, the gentleman was, one, looking at much more expensive transaction through the reverse process, but two, ultimately the property that he was buying was going to ultimately become a primary residence for him. So in that situation, even though 1031 doesn't have any black and white required hold periods, yes, I said that, it does not have any required black and white hold periods. And if you want, take a look at our YouTube channel. You can type in fallacy of 5-year hold, and it's going to talk about this. We've got a page we're going to talk about hold periods during this class too. But in this situation, it didn't make sense for him to do the transaction, because if he's got to buy a property and hold it for, let's say, a year before moving into it, maybe the tax consequence of the sale might be, let's say, 40 grand. Well, he's got to live someplace else for a year. What's that going to cost him? Maybe that's 3,000 or 4,000 a month. So really, it's a wash. So in that situation, don't do the exchange. Just move on with your life and do what you're going to do. But that decision can only be made when you know what the tax obligation is going to be. But that's sort of the way we look at these transactions, and we consider ourselves a facilitation company, not just a mere accommodator or intermediary that's going to hold your money and just sort of be an order taker to do it. We want to make sure the exchange, you can rationalize it, and it's getting you where you want it to be, and understand the opportunity cost involved with structuring that tax deferred exchange. Exchange fallacies, all right? Like kind does not mean house for house, land for land. It refers to the nature of the investment, not the form. So you can go from land and apartments, apartments and office buildings, industrial. If we're going into fractional ownership in property, it's either going to be tenancy in common, or it can be via Delaware statutory trust. But when my brother and I started the company back in '91, I had a gentleman in one of the classes come up, well, I remember when it was house for house, land for land. It's never been that way. In the late I believe it's 97 or so, there was a proposal that would have eliminated the 45-day ID period, which would have been great, because that's just a trap for people. It didn't end up going through because, as always, it was bundled to something else. So they'd say, okay, we're going to get rid of the ID period, but we're going to make a change to the way it is today. It's similar in service and use, it's not form. And they wanted to make it a true like kind, similar in service and use. I mean, it was just a bad situation. So and I think I just said that backwards. I'm sorry, but similar in service and use is what they were wanting, and really it's just nature of the investment, and that's the way it's always been. And once in a while, people just come back and say, well, it is this, and another big fallacy is a 2-year hold. 1031, the only 2-year hold in section 1031, I mentioned the fallacy of the 5-year hold earlier, and that was a result of something called the Housing Assistance Tax Act, and it deals with conversion of properties. We will talk about that in one of the slides. But when we're looking at a 2-year hold, it applies to a related party transaction. So if I were to exchange a property with my brother, then I've got a situation where I've got a mandatory 2-year hold. But even in that situation, you can read the fine print, there's a statement in there stating, unless there was no intent to avoid tax. Well, is 1031 avoidance or deferral? I'd say it's deferral. But in that situation, we typically are going to tell our clients, look, if you're going to do a related party transaction, then it requires both. You could sell to a related party exchange to be fine. You cannot buy from a related party and do the exchange unless that sibling is also doing a transaction. Each of you are going to hold your respective replacement properties for no less than 2 years. All right. So 3, there is no limit to the number of properties relinquished or received. I talked about this a couple minutes ago when we started talking about the identification rules. So I'll say it once again, you can relinquish and receive any number of properties through the exchange. Now keep in mind, you've only got 45 days to identify these properties. And if you're going to buy with other people, you need to identify the portion of the property you intend to buy, not the whole thing. All right. 4, this is a big one today. You can carry a note or land sale contract and do an exchange, but it's a lot more complicated transaction, because typically that paper represents equity. For you to be totally tax deferred in the exchange, you need to have gone across or up in value and equity. Now, this is a topic we're going to address in a few minutes, so I'm not going to go further on it. The important thing to know is that it is possible, but it has to be structured correctly, and we have to be the beneficiary of that note at close. Otherwise, that money is going to, the note is going to be outside the transaction. You're going to have tax exposure. Now, something I really want to stress right now, and we're going to talk about it, I'll stress it more later, is when you sell and carry paper installment sales, all right, people often think they're only going to pay tax on the principal payments in the year of that disposition, annually, and then they're going to only have the tax, that the long-term capital gain on the principal payments and normal income tax on the interest component of those things. It's not true. If you've got a leveraged investment and or one with depreciation, you're going to have tax exposure on debt relief and depreciation recapture in your disposition, whether you receive a single payment or not. So if you're going to consider doing seller finance, you need to get enough on that down payment to cover all the closing costs, because the broker probably wants to get paid, escrow wants to get paid, I probably want to get paid, and you don't want to have to come out of pocket for that. So you better get enough to pay those people at close, any other closing costs, and be aware of what your tax obligation might be on depreciation recapture and debt relief there. So once again, if you've been in our classes, I'll tell you that I think tax people are probably the most important people in your life these days. Death and taxes is the only sureties there. So get some good tax counsel. You don't want to be paying somebody to learn on your behalf. And the same thing applies to lawyers. You want to be paying for an opinion on this stuff. So work with people that have some experience with this stuff. If you've got questions on it, you can start off, give us a call. We'll give you some information that's going to directly address what you're looking at. Then you can take that and talk to your tax or legal people. 5, this is one that comes up a lot right now. You do not have to replace debt in a 1031. So you'll often hear people say you need a new property of equal or greater value, equity, and mortgage. Totally untrue. Okay, the value and equity pieces are correct. You have to do that, but debt can go away 2 ways in a transaction. Debt can go away by going down in value, which triggers tax because you went down in value. The other way, debt goes away is by adding cash to the transaction, which is always going to be fine. So once again, this is probably one of the biggest fallacies in the exchange world, is that you got to replace the debt. It's not true. Finally, 1031 is not an all or nothing affair. Defer as much as you want. As I said earlier, every dollar you spend over your basis represents tax deferred gain. You might have losses. By the way, when you sell and you're looking at tax exposure, it's not actual taxes owed. You're going to work with your tax people and your financial advisor. I'm going to say, talk to all those people and understand, hey, I'm going to have tax exposure on this disposition of the real property. Do I have anything else that I could offset that gain with? Maybe with a loss. Maybe you got a Wall Street loss, something else there. So once again, tax exposure is one thing, actual taxes owed is quite another. And that's why you've got that team of people there. Conversion of properties. This is one of those things that is regularly done, and it sort of dovetails into holding periods, right? Because remember a couple minutes ago, I talked about Section 121 and what's proposed, but what we're looking at today is at 250 or 500. So we've got lots of people when they're disposing of a property. If it's an investment property, obviously 1031 is going to be an option for them. Maybe a qualified opportunity zone is an option for it. If you've got a situation where a property, I was talking to a buddy this morning, City of Portland's been dragging their feet. Could you imagine this? Dragging their feet on a purchase of a property that they're going to take through eminent domain from him. They've been threatening since 2019 to do this. We're going on 6 years now, and he can't really sell the property to be developed to anyone else because it's ultimately the city's going to take it, and the city's just sort of, I feel like it's extortion. But that 1033 is a situation where they're going to take a property, and 1033 is something that if you're selling to a municipality, talk to them about that instead of doing 1031. 1033 is I think a better option for you. 1033, if it's via a fire or something, now that has a similar in service and use requirement. But if it's just a straight condemnation, then you're going to have the same like kind rules you do with 1031s, but you've got 2 years from the due date of the tax return to reinvest. You don't have to reinvest all the money, and you don't have to engage me to get the thing done. So take a look at that. 1033 is great if you're in a situation where somebody's taking something from you. Look at that situation. 121 is a primary residence. It's possible to have a single asset that's going away that has both a 121 and 1031 component as well. Imagine a house on land. You've got the home and then the working land, and you're probably going to want to shove the value of the home up or down to fit 121's max numbers, and then the overage would go 1031. It's also possible if you got that primary residence stay and the gains are well in excess of 250 or 500, you move out of the property. And after holding it maybe for a year or so as an investment, by the way, investment doesn't mean absolutely that it has to be rented out. It's just got to be held as an investment. So as long as you sell it, as I said earlier, within 3 years of moving out, you're still entitled to Section 121's numbers. The overage could then go into 1031. So I'll say that again, upon a sale, you can walk out escrow with your basis and the gain to the 121 limits, then the overage would go 1031. So that's a great option. If you don't want to do that, the other opportunity for you to mitigate some of the tax exposure with gains on the sale of a primary residence in excess of the 250 or 5 is to use a qualified opportunity zone or QOZ or OZ. And if you want more information on that, you can take a look at, once again, our YouTube channel's got videos on there talking about it. A series with Connie Rathbone, who's a real estate lawyer and specializes in the topic. We actually just did a tax update, and Jonathan McGuire with Aldrich talked a little bit about in the tax reform what's happening with the QOZ stuff, and there's another series on QOZs with a gentleman that packages those and sells them, Greg Genovese, to USG Realty Equities. So you can find out a lot of information on that, but that's a way to mitigate gains on the sale of just a primary residence in excess of 250 or 500 too. And by the way, that's really, we lost personal property transactions in 2017 to tax reform. Prior to that, we used to do cars, boats, planes, artwork, and we lost all of that. Businesses even, we lost all of that at the QOZ process at that point in time. So just understand that we can't do exchanges on personal property anymore. It's just for real property. But the QOZ process and urban QOZ stuff is really interesting what they're putting out now, and it's really going to stimulate the benefits of doing a QOZ in a rural area. Is just going to be urban. It's been worked out well for a lot of people, but the rural stuff is really going to be an opportunity for people looking to make projects happen and stimulate development in some of these outer areas. So it'll be fun to see what happens with all that. And actually, I'll go back that slide. One more thing. So, is it possible to take an investment property and buy a property that ultimately is a primary residence? Yes, it is. And remember, a couple slides back, I was talking about the 5-year hold. I was talking about the 1-year hold. And really what you're looking at in that situation is you're going to do the exchange, completing the acquisition into a new replacement investment property, hold it as such for whatever you and your tax people deems a reasonable period. Then you can move into it. Now, don't get the bright idea you're just going to sell it after a couple of years as a 121 deal. You're never going to get that. All right. And that's as of we're talking today in August of 2025. For future context, tax laws change, but the way the law is today, you've got, if you acquire a property via 1031, convert it into a primary residence, do not sell it within 5 years of acquisition. It's going to be a fully taxable sale. Even after the 5 years, you're going to be subject to something called the Housing Assistance Tax Act of 2008, which effectively says you're going to get a proration of the 250 or 500. Those prorations are based upon the gain that's attributable to the qualified versus non-qualified use periods. Qualified use is the time you're living in it. Non-qualified use is any time you've held these properties since April of 2009 to the date of conversion would be the non-qualified use. The date of conversion where you're moving into it and using it, that's the qualified use. So you figure you're going to get, percentages of the 250 or 500. You're never going to get the full 250 or 5. And that's once again with the rules the way they are today. And lots of things are changing. So my advice is, if you do the deal, take advantage of it today, but don't sell that replacement property until you've spoken with your tax or legal people in the future. Give us a call. Well, I just knocked out this slide before I even got to it. So this really just talks about those things. This is the Patrick Racine court case. When people say, well, no, the code says a year, the code says 2 years, the code says 5 years, it doesn't say any of that. This Racine case is a situation where somebody bought a property, held it just a number of months before moving into it. They got audited, taken to court, prevailed in court after, I believe it was a 4-month hold. So now in their situation, what they did is they argued hardship. They relinquished the property, went out, bought the new property, documented the listings, documented the showing for rent, ultimately moved in because they said they couldn't rent the property out. They couldn't afford to cover the payments on the new property and their primary residence. So they decided it was going to be easier to sell the primary residence and moved into that property. So once again, in that situation, I believe it was a 4-month hold, and it was successfully defended in court. That doesn't mean you're going to successfully do it. I think a year is a safe number because of 2 factors. One, that's a break between short long-term tax rates on assets held for investment. 2, it's been proposed a couple times. But ultimately, the hold is going to be up to you and your tax people. If you've got questions on this topic, just give us a call, or your tax people do. We can send you some information on that if this is your situation. So some basics, and then we're going to get into some the complicating factors here. So anytime I look at an exchange, so first off, as I mentioned earlier, we talk about transaction. We do a lot of work in the IRA 401k space too. If I look at a deal in that space, I'm looking at 2 issues. What does the person want to buy, and who are they transacting between, or for the benefit of? It really is that simple. Now, it's a minefield of potential issues there, but when we're looking at a transaction, it really boils down to what the person wants to buy and who are they transacting between or for the benefit of. If I'm looking at 1031, I've got 4 basic issues, all right? 1, it's got to be an exchange. As far as we're concerned, the client's going to relinquish something and receive something. They're going to sell what they don't want, negotiate the sale. We're going to step in, and actually they're going to give it to us. We're going to sell it. They're going to tell us what to buy, and we're going to buy it, and we're going to give that property back to them. A reverse exchange just means if they've got the financial ability to buy something today to replace something that's be sold, we're going to buy the replacement, and then you're going to have 45 from that date of acquisition to ID what you don't want, and then 180 to sell that property. And actually, if you want to work outside the revenue procedure, Rev Proc 2000-37, it might even be possible to go outside that 180-day timeline in those transactions. So just keep that in mind. Typically, we're looking at 180 days either way. If it's delayed, it's 180 from disposition to receive what you want. Reverse, it's 180 from the date of acquisition to relinquish what you don't want. It's got to be an exchange. Something's given away, something's received. 2, what's received, relinquished, and received got to be of like kind. We talked about that earlier. It's nature rather than form. So any real property held for investment is going to be like kind with any real property acquired with the intent to hold for investment. 3, we have to satisfy what we call the napkin test, which says a crosser up in value and equity. And then finally, we must have continuity of vesting. So anybody that's been through an exchange knows that time is going to be the biggest issue. This vesting issue is going to be the next biggest issue. The vesting we're going to talk about further when we're talking about partnerships. And really that vesting issue gets to be a lot more complicated issue if we're looking at a non-community property state than if we're working in a community property state. Because, for example, Oregon, not a community property state, spouses in the LLC, it's considered a legal partnership. If we go to Washington or California, it's no problem. It's not. It's a disregarded entity. So we can have a property relinquished in the LLC's name in a community property state and go out and buy the replacement personally if it's with spouses. Now, other partnerships, we have to maintain that continuity. But if that quote unquote partnership is spouses in a community property state, we can go in and out of the entity, where in a non-community property, we cannot. And that's how easy it gets to be a complication there. Now, this slide is something I think is really important for people to understand. And this is just because deals are harder to get done these days. Now, there are things in our world called accommodating accommodators. Now, if somebody's going to allow you to just identify something at any point, even after the 45th day, that's something that's outside of what we're allowed to do. And that's not a good situation. If somebody's just going to give you money, when you want it out of an exchange, that is not a good situation. You're saying, well, David, I don't really care because I'm going to pay the tax anyway in these situations. The problem isn't you. The problem is that impacts everybody else using that company, because that's a policy or procedure that's not following 1031's guidelines. When we look at relinquishing funds out of a transaction, it is very, very tight. The rule is called 1031 G6. And in a nutshell, it says you cannot receive funds until you've purchased everything you have the right to buy. Now, what that means is if you want to pull money out of a deal, you can pull it out at close and it's specifically excluded from the exchange. If, on the other hand, the money comes to us, you're now married to us for 45 days, because inside that 45 days, you can identify anything you want and you can change things. So you can't terminate a transaction inside the 45 and get your money. After the 45th day, for example, if you set up the exchange and you say, no, I don't want to complete it, well, let us know. We'll send you a term pack basically asking you how you want the money, and we can arrange to get you the money on day 46. But we cannot give it to you inside the 45 days because you can continue to identify additional properties. Now, after the 45th day, you can only get the money after you've purchased everything you have the right to buy. So my advice is do not identify something unless you truly intend to buy it. When you get that 45th day, you really need to look at it and say, okay, is everything going to close the way I want it to? Is this what I really want to do? And am I committed to buying this property? If you're identifying multiple properties to buy multiple properties, then that is fine. If you're identifying multiple properties with the intent of buying one of them and you want some money out at the end of the day, you need to specifically state that you're identifying multiple properties with the right to buy one. Now, when the rulings came down and forcing this 1031 G6 compliance, then we amended our identification form. And in the body of it, it basically says you're identifying these properties, but you have the right to buy blank of them. And that was put in place because of our clients that would have all the money come to us, buy a property or two, but they wanted to get some money out at the end of the day. Because what happens if you identify something and we pass that 45th day, you cannot rescind the identification at that point. We could not give you your money until day 181. Now, if you said, hey, I'm identifying 3 properties with the right to buy one, and you put that one in that blank, and we've now closed that one property and we're on day 60, we can get you the balance of that money. That's fine. Now imagine the situation where you just you just ID'd a property just in case, and it's now day 50 and you find what you really want. That's not a good situation, because now I can't give you the money till day 181 and you've got this other property you really want. So back to that 45 days, really make sure you treating this seriously. And it's always amazing to me how people will go on vacation inside the 45 days and then something happens with their deal. So, prioritize. You're going to do what's important to you, and really work to make sure you're taking that identification seriously. And that if you want to pull some money out, have that discussion, because like I said earlier, we can either give it to you at close or after you've purchased everything you have the right to buy. Partnership exchanges. So a partnership can do an exchange, but the members cannot. So what that means is if, let's say, 5 of us go out and buy a building and we use a limited liability company to own that building, I would say before we close on a sale, I would say before we even put the property in the market, maybe a year in advance, we're going to do what we call a drop. And that drop means that we're going to deed the property from the entity to the, let's say 5 of us tenancy in common. If it's something where we don't want liability on it, we could be 5 different LLCs tenancy in common, that's fine. But we need to break the entity. So once again, the partnership can do an exchange, but the members cannot. So a drop and swap is a situation where we are dropping out of the entity pre-disposition. Ideally, there's a seasoning period between the drop and the disposition, and not with a sale pending. All right, but 9 times out of 10, that happens while a deal is pending. Escrow is drawing a deed from the entity to the individuals. The purchase sale agreement's amended. Ideally, it would be replaced with a new purchase sale agreement showing that the tenancy in common is selling that property. And like I said a couple minutes ago, ideally I'd do it a year in advance, but 9 times out of 10, it doesn't happen. One, because people don't think about it. Two, you've got to really change all your, you might have a loan on the property. That might be accelerated. You're going to change the rental agreements, bank accounts, all the tax work, everything's got to be done. There's a series of things that have to be done to effectively break that entity. You can't just deed it out and say it's gone. So you really have to make a lot of changes. So that's why a lot of times it doesn't happen pre-disposition. The drop and swap is best because, of the 5 of us, it's common that we don't want to buy things together, and maybe we just want to go different directions. But if we have gotten to a point where we've got a closing pending, and we want a more conservative transaction, a lot of times we might do a swap and drop. And all that means is that we're going to do an exchange for the entity into maybe the 5 different properties each of us wants, but ideally we'd buy each of those replacement properties via single member limited liability companies with the exchanging entity as its member. A year after acquisition, let's say, at that point there'd be an assignment of membership interest from the entity to you for yours, Susie for hers, Peter for his, and anyway, so we get all 5 of us where they want to go ultimately, but it takes time, and that's probably a more conservative way. But if there's financing there, then that can be a hiccup too. All of this is to say partnerships can be sticky. Now, if it's an S Corp or a C Corp, just taking the property out of the entity is going to trigger tax consequences that probably are going to eliminate any benefit of doing an exchange. So it's really important we look at these things, understand what you're trying to do up front. And this is why I made a comment about intermediaries or accommodators versus facilitators. I mean, we had a situation. This is a true story. Last year, we had a unfortunately terminal exchangor that had an exchange set up with one of our competitors, and the broker was on top of stuff. He said, "Hey, I didn't want that set up there. I wanted to work with Equity Advantage," and so we get involved with the transaction. And it turns out, he's terminal, like I said, and his spouse isn't on any of the properties. So the really, sad thing was this party passed away in the middle of the exchange. If we hadn't got the spouse on those properties, how are we going to get the deal done? Because we do have to complete the transaction. That disposition happened while the gentleman was alive, and we needed to get it going forward. So, does a deed necessarily indicate ownership? And I'm going to tell you, no. In that situation, they'd been married for decades, filed jointly. It was just an oversight. She hadn't been on there. So for her to be added immediately pre-disposition was not a problem. So we actually instructed escrow to add her to title to the properties that were going away, and had the exchange agreement for both of them. So that way, going forward, everything worked out. If we hadn't done that, would have been a real problem going forward. So that's why it's facilitation. You got to look at this thing, and don't just flippantly do the exchange the 11th hour because you think you want to do something. Really think about it. Think about it early, and make sure you're getting the most out of it. The old saying, those who fail to plan to fail. So really ask the questions, and as I said at the top, the only dumb question is one you don't ask. Related party transactions. We talked about this earlier. So if you're in a situation where you want to do a transaction with a sibling, now this is another class. I'll tell this story. We've got a few examples we need to get through. We've only got about 18 minutes left now. But the idea is related parties can do transactions along together. But if we're doing transactions between related parties, selling to a related party is fine. Buying from related parties typically considered only fine if that related party is also doing an exchange and both of you hold your respective replacement properties for no less than 2 years. So just keep that in mind. It's typically not a good idea to be buying from a related party if he or she is not doing an exchange. Who's a related party? So your lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. So once again, a related party is your lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. That would be considered a related party transaction. Notes and seller finance. Remember, we talked about this earlier, and this is just a really timely topic. It's one of the most viewed videos we've got on YouTube, with tens of thousands of views on the thing. And you know what you're looking at. First off, if you sell and carry paper, whose paper is it? It's yours. So don't let the nice buyer's lawyer draw a note or contract for you. Make sure that if you're going to do it, one, make sure you understand the tax obligation you're putting yourself into. But two, make sure that if you're doing it as an end game, and it can be a great end game if you don't want to go buy anything, but make sure that you've got an acceleration provision in there, making sure that somebody doesn't just put it in place and then pay the thing off immediately thereafter. Two, make sure you don't allow blind assumptions of that paper. What happens? The buyer buys the thing and then they want to sell it, and they just want to allow their hand-picked buyer to take over your contract. That doesn't sound like a good idea to me. So make sure that you're taking care of your best interest with any acceleration provisions in there, and prohibit blind assumptions. If they ask, then you can go along and do whatever you want to do on it. But it's really important you understand these things. So as I said earlier, in seller carries, you're subject to tax exposure on debt relief and depreciation recapturing your sale. You need to make sure you get enough to cover any tax consequences of those, plus all the closing costs in that situation. I had somebody in here, I don't know, probably a month ago now, and it was a very large property, and there was a situation where they were looking at a seller finance scenario, and I said, well, why is the seller finance there? It's going to make your transaction immensely more difficult. And so, oh, we just thought we'd do that for the buyer. And I said, okay, so what kind of interest rate were you looking at? And it was actually an interest rate that was lower than what bank money would cost. And I said, so that's the other piece of it. If you're accommodating somebody, or you're doing it as an end game on top of those other requirements or suggestions I had, I would make sure that I'm getting an appropriate amount of interest on this money, and that appropriate number should be in excess of what bank money is. You're doing this for a reason. There's risks involved with it. You deserve to be taken care of on that situation. So with that said, if you have to carry a note and you want to do an exchange, then we have a variety of opportunities here. One, what happens is that note comes to us along with any cash at close. We're then going to use the note and cash to go buy something. That would be an option. It rarely ever happens. The seller doesn't want the thing. They don't know anything about their buyer. Maybe we're selling the note to a third party, which used to happen a lot, which I haven't seen that happen recently. And a lot of times the discount might be sort of in line with the tax consequence. Another option would be for our client to buy the note. And this is the one that typically happens. You go, David, why would I buy my own note? What you're really doing is substituting cash for the note, which allows you to complete the transaction totally tax deferred. I've had people borrow money from the bank to buy the note. If that spreads there, that can make sense. You get a couple of points. Where else are you going to get that return? So a lot of times, typically when we have seller finance, our client buys a note from us, and then they've got the benefit. If they've got $500,000 sitting in the bank, paying them 3%, 4%, maybe at best, and the note's paying 8%. Hey, that's a much better situation. So that's why people do that. And then what happens is we've got the money to complete the transaction, keeping them total tax deferred. Another scenario that comes up is short-term seller carries. It's there for a period of time to get a deal done. I'm not going to talk much about this right now because I've got an example we'll talk about. But if maybe it's lender required repairs that need to be done, maybe financing blew up. So as long as what will happen is the note comes in, as soon as the note, the balloon payment comes in, we have the cash to complete the acquisition. So it needs to happen inside the 180 days, ideally inside the 45. but as long as we've got a balloon payment coming in, we've got the ability to make our client whole through the transaction. And then finally, we've got partial exchanges that can be done too. So as I said earlier, 1031 is not all or nothing, so you can always do a partial exchange. So reverse exchanges. So what has to happen there? One, I'm going to tell you, you cannot legally own both the new and old property at the same time. Now, this has been a problem over the last few years because somebody will say, hey, gee, I've got this property all locked up. My relinquished property's in escrow. Then the relinquished property blows out of escrow and they still want the replacement property. And somebody says, well, just buy it and we'll do a reverse exchange when your other property sells. You cannot legally own the new property and the old property simultaneously. So if you want to do a reverse, the exchange must be structured prior to close on the acquisition. So what will happen is you've got to have the financial ability to buy a property today to replace a property yet to be relinquished. Now, depending on whether you have as much or more to put down as what you expect to net from that future sale, if you've got as much or more to put down, then that gives us the ability to do an exchange either way. If you've got less to put down than what you expect to net in the future, that typically is going to tell us we need to do what's called a warehouse replacement transaction. So we do reverses in two flavors, a warehouse relinquished and a warehouse replacement. The warehousing or parking references which property we're going to take title to. So if you got the financial ability to buy this thing today to replace something yet to be sold, you're going to show up at purchase with the money required to buy it. We will have generated a note saying we borrowed that money from you to buy the property. The note's secured by the property. So you loan us some money, we buy the property. We've created a single member limited liability company, either in a generic name or ideally in the name that you'd ultimately like to own the property in. And we close on that property. You're going to manage it. You're entitled to the upside, on the hook for the downside during the time we're on title to it. When your property sells in the future, we're going to take the proceeds, repay the debt we had to you first, and then any additional money can be used to pay down the property or maybe build on the property or buy an additional property. And if we're buying additional property, you'd have in essence 45 from settlement to ID what else you're going to be buying in 180 days to close on those properties in excess of that one we've been warehousing. But at that point, we would convey ownership of the replacement property to you, completing the exchange. That conveyance can be either via deed, or as you heard me say a minute ago, we could do the entity in the name that you ultimately want to own the property in. If it's you alone, or as long as disregarded situation, we just simply do an assignment of membership interest from us to you completing the transaction. I like that structure best. Something to keep in mind is if we're using that structure, title policies are going to be in place. If we're not, you need to make sure when we're buying that property that you're putting any additional insured that you want on the title policy, so the policy is actually worth something when it's conveyed to you. Now, if we're in a situation where you're financing the property and you have to take ownership of the replacement property, then we would use that warehouse relinquished structure where we're actually taking ownership of the relinquished property, not the replacement property. So warehouse relinquished references us taking ownership of the relinquished property. You would show up the purchase once again. We'd borrow the money, we'd buy it, we'd immediately give it to you. We would be on title of the property that's going away. Effectively, the exchange is done at that point. We've just got a debt we've got to pay back to you, and that debt's paid with the proceeds from that future sale. If we have less money coming out of that sale than what you put down, then the balance of our debt to you is forgiven in that you received equity that offsets that. If there was a gap there, you may have a situation if you didn't have the ability. If we did a warehouse relinquished, we've already conveyed the property to you. We can't take additional proceeds, pay down the debt on a property you've already owned. So that's why I like the warehouse replacement structure better. One is that we have the ability to bury additional money. Two, we can actually build on the thing during the time we're on title, which leads me to an improvement exchange. Well, blended first. Blended we talked about. blended. So I gave that example of the 8 properties with that person, or first deal, doing the deal with the 2 brothers. So what happened in that transaction, and we'll get the improvement transactions, but in that deal, what happened is a couple of deals, let's say 4 or 5 of them had closed pre-acquisition. Those all came in via delayed exchange. Now, keep in mind, you've got to identify, you're going to identify that replacement property both as a whole in hopes that all 8 would have gone away, and you're going to also identify it as a blended transaction. So you'd identify, let's say, 50% of it or 60% of it, because that's what we're buying with those properties that came via the delayed exchange. A blended transaction is really the combination of a delayed exchange and a reverse exchange into one replacement property. So what happened in that transaction, 4 or 5 went away via delayed exchange. When we bought that property, we ended up conveying the whole thing. We had the balance from that acquisition date. We had 180 days to sell the other 3 or 4 properties that were the stragglers out there. As those sales came in, we used the proceeds from those sales to repay the debt we had to the brothers, and they successfully combined all 8 of those relinquished properties into one replacement property. And I don't remember the exact total amount of time, but they had up to a year to get that deal done with proper planning in that situation. So really, planning is a big secret to success here, more than ever. Improvement exchange. So we cannot, I guess first thing I want to say is I'm talking to you from Portland, Oregon. All right. Now, Portland, despite what our governor says about wanting to help stimulate development and make things happen, they need to get out of the way, because the problem is that, one, the cost of, especially if you're looking at affordable housing, the cost of getting a shovel in the ground is ridiculous when you start looking at site development charges. But 2, I only have 180 days to get stuff done. My clients can't even get a permit in that time period. So to do a regular improvement exchange up and down, really, and I've been picking on Oregon, but the same thing's going to apply to California or Washington. It's just not going to happen. If I go to Texas, somebody can walk in there with an application, walk out of planning department with permits, and we can hit the ground running building. So it's a totally different situation there. But we need to look at, anytime we're doing an improvement exchange, we need to look at what's to be built. And we need to make sure that we're going to get permits and get the ability to build this stuff during that exchange period, and that can be very difficult. So really what happens is we are going to buy the property to be improved. We're going to do the improvements. The improvements don't have to be done, but only what is completed and constitutes like-kind real property qualifies towards the exchange. So we can't prepay labor and materials. So it's really important. Timing is critical in these transactions. So once again, we cannot give the property to the taxpayer and then do the work. We're going to do the work to the property that's owned by our limited liability company. In the exchange world, it's called an Eden Exchange Accommodation title holder. We will buy the property, do the improvements. You're going to oversee the improvements as normal, and then we're going to convey the improved property back to the taxpayer. We're typically going to convey it back to them either upon completion of the improvements, exhaustion of money, or satisfaction of the exchange. Or just exhaustion of time. Those are going to be the transfer times. And once again, we can't prepay labor and material and have those things of like kind. The other thing I want to say is that the value of that replacement property, and what you're identifying is the property plus the improvements you want to do. The value of the property is the acquisition price plus the cost of improvements. You can't say, hey, I bought it for X, did Y in improvements, and you can't say that sum of value is in excess of the purchase price plus the cost of the improvements. So just keep that in mind too. So at the end of the day, you're going to have a paperwork that you're going to get back to your tax bill reporting the transaction settlement statements from both sides, along with you're going to have a ledger that basically shows every draw that was submitted to us, approved by you and paid by us. We're not going to pay anything without your John Hancock approving the draw. but you're going to get that information back to your tax people. And with any exchange, you're going to file an Form 8824, which is in effect a basis carry forward calculation. And it's no different for an improvement exchange, reverse exchange, or delayed exchange. That thing needs to be filed. And one comment, I guess, on 180 days too, late year transactions, be careful, because the fine print of the code says you got 180 days or the due date of the tax return. So imagine a situation where you closed a deal November, December, and now you're banging up against April 15th there, and you got a tax return due. You better, and you haven't closed on the replacement. You got to file an extension. Do not file the return before completing your exchange, because if you do, you've just terminated the transaction. So be careful with that stuff, any late year transactions. Improving property already owned. Now, this is something that is really, I guess, both a little frustrating and comical to me, because for decades now, we've got so many in the exchange. I think there's only one other company that I'm aware of that's been handling improvement exchanges on property already owned, and they're out of Florida. But forever, I've had so many tax and legal people told by so many accommodators, you can't do that, you can't do that. And just in the last few months, our trade organization had a seminar talking about this new process, how you can do a leasehold improvement exchange. And now I've got somebody putting stuff on YouTube talking about it. And this is not new, okay? We've been doing improvements to property already owned since we started the company in 1991. Now, during the 90s, what would happen is you would sell the property you don't want, the property to be improved, you'd deed over to us. We would then build out what was needed improvement-wise on that property, and then convey the improved property back to you, completing the transaction. In 2000, when we got RevProc 2000-37, the safe harbors for reverse exchanges prohibited your receipt or ownership of the new and old property at the same time, and it prohibited receipt of property already owned as replacement for property being relinquished. So we had to go back to the drawing board on this, and our outside legal counsel at that point in time was a gentleman named Ron Schellen. He worked at Miller Nash. For those of you on the call that have been in real estate for a long time, you know Ron. And so we came up with the leasehold structure at that point in time. So if you look at like kind, as I said before, refers to the nature of the investment rather than the form. We can go house to house, land for land, apartments into land, into mini storage. All those things are going to be of like kind. Now, if I was looking at one of our exchange diagrams or like kind diagrams, right about 10 o'clock, it talks about a 30-year leasehold interest. So a lease of 30 years duration or extensions to 30 years constitutes like kind real property. And this process is actually in the Oregon State Bar's practice manual on 1031s too. And if you're contemplating one of these things, call us up. We're going to send you the case law supporting it. We're going to tell you exactly an overview of the process and a step-by-step of how we do it. But what we're doing is we're not going to take ownership of that property to be improved. We're going to create our limited liability company. It's going to enter into a long-term lease with you for the property to be approved. We do not want the exact same taxpayer doing the exchange as owns that underlying dirt. So we're going to change that a little bit, and that's a conversation we can have. But it needs to be structured properly, and if it's done correctly and things, what happens is when we're all done with it, we're going to convey only the leasehold improvements back to you, and we're either going to assign the lease to you, our exchange, or we're going to assign membership interest in the entity that we've created the lease for, our entity. And that lease needs to be in place for a couple of years after we completed the transaction. But this process is beautiful because, one, it allows you to do this stuff, but two, it makes improvement exchanges up and down the West Coast possible, because you can go out, get the planning, engineering, permitting on the property, and then when your property goes away, we're ready to go and we build it out. So it's really a great process. Has worked well for us since we started the company, which is back in 1991. So the leasehold structure wasn't the first decade. It was 2000 when we started using the leasehold structure. But it's been very, very good for us. We've done deals all over the country and of all different scales. It's an expensive transaction, so don't think, hey, I've got $30,000 in gain and this makes sense. The cost of the transaction is going to be probably in excess of what your tax on just pulling the money in that situation. So if you got $50,000, $100,000 in tax exposure, then it's going to make sense, and this can be a wonderful transaction for you. A few examples were done, so we're technically out of time. I'll try to get through these quickly. And if you've got questions on these things, once again, don't hesitate to reach out, and happy to talk to you about it. So this situation where we had this is a large institutional transaction, both sides. We had somebody that was selling, and actually they were working with another company at the time we got involved with it. Our client was up against the 180th day. The financing blew up. And the first conversation with the seller was, oh, well, I said, no, you don't understand. If you don't do this deal, make it work, the deal's not going to happen. Because the problem was our client was going to be subject to all the tax exposure, and they would no longer have the ability to buy the property. So what I told them they needed to do is a short-term seller carry. So we ended up taking the transaction over because our accommodator didn't understand what was going on. And so we ended up taking the seller's transaction, completing our buyer's transaction into this deal, and we used a short-term note trustee. So what happened is the note came to us along with the cash, and our buyers, their exchange was done as soon as we closed on it. Their permanent financing was going to be in place, even though the one source had blown up. They looked at about 3 weeks out, and the permanent financing was going to be in place. So we saved their 1031, had the note for about 3 weeks. The balloon payment came in, taking the note out. Now we had all the cash from the sale to then complete our new seller side transaction into what they wanted to do. So, once again, this is a deal that wasn't going to happen. It was a 11th hour blow up of financing. The short-term seller carry enabled both our buyer to complete their transaction, which wasn't going to happen, and it allowed our new client, the seller, to do their exchange using a short-term seller carry, and everything worked out. So you just gotta have the tools there, and when you're looking at who you want to be working with in these transactions, I really can't stress enough. You want to make sure that you're working with people that have been through these things and have worked a number of years to understand what's possible and what they should not be doing too. So this is a transaction, just people giving up a vacation rental in California and ended up wanting to go into a series of single-family rentals. They were doing fixers on those, and they end up buying a multifamily complex as well. Now, flipping property, even though you might want to argue with me that's an investment, it's not. Flipping property is a business. The problem with flipping property is, one, you can't do an exchange, and two, you're looking, no matter how long it takes you to do the improvements, you're looking at normal income tax on as a tax consequence. So instead of, let's say 40% or so tops, you can be in excess of 50% if it's normal income tax. So it's really important that you understand what flipping is. So what was being utilized in these transactions is an acquisition, and I get a kick out of all these people running around like BRRRR's a new concept. Well, people have been doing this forever, and we just didn't have the acronyms in the old days, and you take BRRRR, it's BRRRR on steroids, I guess I would say. If you got to flip and you got to do a few of those, get enough critical mass to do more, fine. But why would you pay tax if you don't have to? So instead of buying, fixing, refining using BRRRR and then selling and paying the tax and going forward, what you're going to do is buy, fix up, rent, refi, season the thing for a couple of years, maybe a year, maybe 2 years, depending on what your tax people want to do, and then you do an exchange on it, and you've got that transaction. Refi money's not going to be taxable to you, and you've totally deferred all your gain using 1031. So it's a great way to snowball equity and keep you going in the right direction, and take advantage of that value add situation that a lot of property offers. This is an example of that phantom gain situation. So during the last recession, we had a number of institutional transactions that were going south. for people that didn't understand. So if you've got debt on a property in a foreclosure, I said it earlier, but I'm going to say it again, debt can be treated as a sales price. If the debt on the property is in excess of the basis, that difference is called phantom gain. So in these transactions, what would happen commonly is you'd have a servicing agent working with the investors that own the property. And the whole idea was, hey, we're going to refi the thing, save everybody, and everything will be great. And once in a while, the servicing agent, maybe even the servicing agent, would be predatory. And you say, well, no, we're not going to do it. We're going to foreclose on the thing. And in that situation, if people are not made aware of any potential tax liability, they might be trapped in that scenario. For people that were made aware of that, and we did deals all over the country in this scenario, what would happen is typically these institutional ticks, which meant that we had a series of limited liability companies disregard entities tenancy in common. So pre-foreclosure, we get a call, say in 48 hours, this thing's going to go away. We do assignments, membership interest, conveying the relinquished property from the taxpayer to us. When it's foreclosed, it was ours, not theirs. But that assignment of membership interest, that started the clock on the exchange, the 45-180. And the idea was this: you lose it at foreclosure, you're paying up to 40+% tax, or maybe you go into a Delaware statutory trust, 80%, loan to value, zero coupon offering is what they call them. So you pay twice as much to get nothing, you pay half as much, get something. You're not getting mailbox money that the DST typically gives you, but when it's gone full cycle, 5 to 7 years later, you've got equity that's built up in there, and you didn't have to pay twice what you had to go buy something. So, just be aware if you're in a situation where, if you're a broker, you're aware of somebody having this problem, or if you're an investor sort of facing this problem, be aware of your tax liability and understand what is possible. This is just a situation where you're looking at a disposition of a property that had $3 million in gain, and this was a number of years ago. If you've been in my class before, I always use this example. It's just too good not to. So they're going to pay $3 million gain. It was going to be $1 million in tax. All right, that was not a good situation. So their lawyers sent them to us. We told them to move out of the house. They moved out of it. Their tax people were good with a year. Once again, it doesn't have to be rented. It's got to be held for investment. When the property sold, they still were entitled to 121s, 250, or 500. In their case, married, so they took the 500 exclusion, and then the overage went 1031. Now they ended up going from $1 million tax hit, bought 24 different replacement properties, closed them all inside the 45 days because she was a CPA. She knew the consequence of dealing with the 95% ID rule, which means you got to close 95% of all properties identified. That would typically mean one sale fail would blow your exchange. So they went from $1 million tax hit to zero, got 24 different replacement properties, and I think that's just a win-win for everybody involved. Okay, in this situation, we had, and this is the last example, but once again, planning, taking the time to work stuff out. So I had a real estate broker developer do a lot of work with. He'd bought a large parcel of property. He'd gone out on the planning, engineering, permitting put together. And what ultimately the objective was for him to be ultimately a partner with our exchange or complete the transaction. So what he did is he sold the property very, very small gain, had exposure on that, but he did it on a seller carry. And since the gain was small enough, we didn't really have to worry about it. He didn't do an exchange. He just was looking at an acceptable amount of tax, and that note wasn't going to trigger that big an issue for him. So with that virtually nothing down transaction, it allowed us to complete the acquisition into that property and then use all our clients' equity to then build out the improvements. So which is a large multifamily project. And instead of waiting 2 years to get permits, we are actually able to hit the ground running. It's possible, if we're looking at that leasehold improvement process, we can actually do a reverse leasehold improvement too. But in this situation, you've got to look at where this is. This is in Oregon. So different times of year, what do you want to, when do you want to build, and what impacts is this hunting season going to have on you and everything else, right? So we've only got 180 to get the work done, but in this situation, we had all the clients' money to go vertical on it, had some other finance money that came in. We built the thing out to a level that satisfied our clients' needs. We then gave the project back to him. He completed it. Now, the broker was still a lien holder on that property. So ultimately, how did we aggregate their two ownership interests? Well, we created a new limited liability company at a later date. The taxpayer, our client, contributed his property into that entity, receiving a membership interest attributable to his equity. At the same time that was happening, the broker contributed the note, receiving a membership interest attributable to the value of that note. And now they jointly own the property via that limited liability company. Now, going forward 5-7 years later, what you're going to do is drop back out of the entity tenancy in common, and then each party would have the ability to go different directions. Or you could just, if everybody's happy going forward together, we just keep you in the limited liability company and do that. But that's a great example of working with a team that understands rules, has the time, takes the time to plan out really what needs to happen, and we're able to accommodate everybody's needs using this structure. And I think it's another great example of what's possible using 1031. So we made it, and I would just once again, if you're probably here because you're on our newsletter list, please don't hesitate. If you're not on it, reach out, get onto it. But take a look, like and subscribe to our different sources. It really helps us out. If you've got questions on things, especially the YouTube content, we find it's very valuable to hear from our clients if they've got some question on something that has not been addressed by us or somebody else out there. So our most recent podcasts at this point probably are to do with the Tax Reform Act. We've got one set with a gentleman from Inland Private Capital out of Chicago, and that's a great one because he works heavily with the U.S. Chamber and a variety of other sources, National Association of Realtors, and he does a very nice job of talking about what has happened with the tax reform. And then the second series was with another gentleman that's a CPA that we do a lot of work with, Jonathan McGuire, and he did a great job of talking about a variety of things. And he includes, one of his real strengths is QOZs, OZs, so the Opportunity Zone updates, and talked about rural versus urban and what's happening with that too. So thank you very, very much for the time today. If you want or need credit hours for it, you can reach out to cmoore at 1031exchange.com, CMOORE at 1031exchange.com. And it's been a pleasure to have you today. David Moore signing off. Bye-bye.